Paul Singer to start us off.
Thanks, Rod. A week from tomorrow, we're celebrating our 20th anniversary, and the thing that strikes me about that is not just that we can do this and make a rate of return with no losing years over 20 years, but that in that period of time, we've seen very little in the nature of different kinds of environments that would test money managers in all conditions. There was the crash of '87, of course, but the crash of '87 was more in the nature of a nightmare from which you wake up and the sun is shining again, and you have occasional nervous twitches, and you wake up in sweats for a few nights or a few weeks or years thereafter. But it was there, it was unprecedented, it was steeper than 29, and it was over with no lasting economic consequences. So by the end of '88, the effects were reversed. You had the bond crash in the late 70s, but what you have is something that at this point resembles, say, almost a never-ending series of favorable environments for financial assets, in particular stocks. I don't want to belabor or spend a lot of time on where the markets are in the world today. Obviously, the U.S. stock market is in, by many measures, unprecedented valuation range. There are people that point to the fundamentals, which are very excellent for America and for financial assets, and say, well, that justifies it. One has to say, however, that market timing is not something that has stood very many people in good stead. I think it's virtually impossible on a consistent basis. So rather than say that the stock market, the U.S. stock market is particularly risky, I'd like to just discuss factors involved with risk, things that you should think about as you're thinking about the risk of any particular portfolio, hedge fund in particular, because hedge funds are more or less unfettered, and we can do more or less anything with your money. And you ought to know some of the things influencing what kinds of results and reports you get in different kinds of environments. One thing I will say is that, to me, to some people, risk means the risk of underperformance on a benchmark. That's not my definition. And in fact, benchmark investing is one of the things causing one-way moves in the financial markets, meaning moves that just keep going and going. Some people also associate that with momentum investing. When you have to overperform a benchmark, you keep reaching. It's why Microsoft is, with $10 billion in sales, is selling for $140 billion. If you think that Microsoft stock today will generate for you a 15% return in the next 5 years, then you're saying that Microsoft market cap 5 years from now is $280 billion. I'm not going to stand here and say that that's not going to be the case, but that's the consequence of momentum or benchmark investing. Together with the fundamentals, I'm not going to say it's the world's most wonderful company. So let me talk about some of the factors involved with thinking about risk. One factor is leverage. And in the old days, leverage was relatively simple in concept and relatively hard to get. The margin requirement is 50% on stocks and different numbers for different assets. Today, to make a long story short, I could convert my entire portfolio to a total return swap and put up a ridiculously small amount of money between swaps, futures, forward contracts, different forms of derivatives, and other ways to magnify your portfolio, options, warrants, whatever. Leverage is a matter of choice. It has a couple of implications, or it has a few implications. Given any strategy, given any technique, whether hedged or unhedged, it's just a simple fact that magnification, which is all leverage is, magnification of position size per dollar of capital, magnification increases risks. thing that you want to know as investors is just, well, what is that magnification? I think you have to look at these things as notional values. If there are swaps, you have to see what the notionals are. You have to see what's on either side of the equation. Go read those footnotes. They're pretty dense, but they're pretty informative. Today, every hedge fund balance sheet has an extremely turgid page at the end with this odd breakdown of different kinds of derivatives and futures, options, forward contracts. And it's very hard to tie them into the balance sheets, but you ought to do it because in many cases you're talking about currency hedges, which if you're hedging it back to dollars or to some other currency, don't add to risk, and you have to subtract the risk. But in other cases, you're talking about risk assets, which are magnified. Magnification increases risks, all other things being equal. Now, another thing magnification and leverage does is increases, it's obvious, but you've got to think how it all comes together, increases purchasing power. What that means is that the ability of different asset classes to become overvalued or undervalued as an unwinding leverage is much higher today than in the past. I also think that the concentration of portfolio decision making and thinking together with leverage imposes a new paradigm of risk. People ask me in the U.S., is there a new paradigm of stock market valuation? Should we throw out the old valuation measures of stocks? I think not, but I don't want to discuss that here. What I do think, however, is that there's a new paradigm of market movement, and it's composed in part of the concentration of communications, the lightning fast ability of mutual fund investors to buy the funds, to redeem them, mutual fund investors thinking that they have something like cash and confusing liquidity with risk. That is to say, they think that the 800 number provides an immunization against risk. All the 800 number does is make their mutual funds something like unregulated banks. And this is a point that I think is very important to focus on. Is the mutual fund industry, in thinking about the overall risk posture of financial markets, is the overall mutual fund industry, particularly in the United States, like an unregulated bank in which assets are invested under an assumption that they can be withdrawn instantaneously and then invested into long duration assets, which is what stocks are, without any insurance, by the way. I think there may be something here. You don't have to be apocalyptic to realize there's something. But following answers to a recent poll. A recent poll of mutual fund investors say that 40% of those polled think that there will be no 10% decline in the U.S. stock market in the next 10 years. 20%, I think it's 20%, it might have been 17%, that's the number that sticks in my head, think that the market will do as well in the next 10 years, which I think is a mid-teens rate of return. In the next 10 years, as in the last 10 years, which is something like a mid-teens rate of return now. It doesn't mean necessarily they're wrong. It seems to me to be a pretty brazen prediction by people. And it bespeaks a kind of it shows you who are these people, because they hold the trigger. The mutual fund portfolio manager, presumably the professional who has a professional's discipline and expertise, that person does not, he or she does not hold the trigger. The person who answers these ads pulls the trigger at the margin. So there's that pool of capital. There's one financial newspaper in this country. There's one financial daily. There's one weekly, effectively. There's a couple of TV stations and a couple of commentators. And to ask why is the stock market at 7,000 is to say, well, none of us can really construct scenarios that are truly realistic and apocalyptic. And so that's the environment in which we all think about things. The consequence of this concentration as well as leverage. And I think leverage is much more present in the system than 10 years ago, 20 years ago. You don't just look at margin bank, you look at all these derivatives and all the quantification. And you say to yourself, if the markets change, and I'm not sitting here predicting that the markets are about to change or that they're too high and they have to crash. If they change, it's not that the exit door will be narrow, it's that there will be no exit door, because people who are subject to the same influences of thinking will change their minds all at once, or more or less all at once. And any revaluation may be very, very rapid. So that when you're thinking about risk, I think you have to think about the fact that these factors, the technicals in the market, may be imposing risks greater than what you see. I think it's very important when you're thinking about risk to look at 1994 and 1987. The question for those two periods, those episodes, because 1994 was the bond market analog in 1987. Unprecedented, multi-sigma, way out there, upbuilding curve, movement in the fixed income markets. It's boring to list the sequence of events that caused this, tightening, blah, blah, blah. Doesn't matter. The issue is, are these two events, the 87 crash, the 94 bond market episode, these once in a lifetime, which the probability curves would indicate, events, or are they the paradigms of what happens with all this concentration, same thing, derivatives, leverage. We'll know maybe not too far in the distant future if the markets keep going up or calm, punctuated by occasional 2% declines or 5% declines, on and on and on, then maybe that's the answer. But it may not be the answer. And I think when you're thinking about risk, one of the things we'll think about is, can we accurately, given the changes in the technicals, the changes in the marketplace, the changes in who owns financial assets, and their ability to do so on very high leverage, their ability to concentrate, momentum investing, etc., are these changes qualitative changes which change one's ability to draw correlations among classes of assets? I think that may be the case. And I think the bottom line, in my thinking of how these factors interact together, is that I think we ought to be very reticent about drawing very finely tuned quantitative measures of the way assets interact with each other. Therefore, concentration, to me, increases risk. Position size per dollar of capital, that's to say leverage, increases risk. When you're thinking about risk, you can't ignore these things. They're really the cornerstone of thinking about risk. What are some other things? In an article I wrote, I also wrote about what I call the human factor in thinking about risk. And I started investing, in fact, Lou Margolis, a pal for over 20 years, he and I spoke about investing and risk and options and optionality. It's kind of in the middle of the 1973-4 episode, which was the most painful episode of our lifetimes, and probably anyone around here's lifetime. And what I mean by the human factor is, how do people really think they will react when the backdrop changes? How do you really think you will react to losses? There's some, what I consider hilarious, recent polls that in which people are polled and asked, will you sell your stocks or buy more stocks if your stocks go down 10%, 15, 20, 5, whatever? Most people said they will hold their stocks or buy stocks, whatever. I apologize for being so harsh in my judgment about this, but it's the analogy I thought of was Marine boot camp training ground. Again, pass out a questionnaire. On the battlefield, with bombs falling all around you and your buddy's dying, will you cut and run, Will you jump up and charge the machine gun and ask the records? It's completely absurd to ask people in a calm, optimistic, blue sky environment how they will react when a typhoon is overhead. And I think coming from my archetypal memory of the days of the spring and summer of 1974, which is a little bit analogous and kind of reverse from what's happening today, every single purchase was instantly punished, whether it was 5 times earnings or 2 times earnings or 10 times earnings, instantly punished the next minute, the next day, no later than 2 days later, with a loss. And it was a bigger loss and a bigger loss, and it just went down and down and down and down. You could say all you want about values, you could look at the balance sheet, you could talk to the president, it didn't matter. The analog today is, it doesn't matter what you say about Microsoft. It went up yesterday, it's going up today, it's going up tomorrow, whatever. It doesn't matter. The human factor means, can you withstand, maybe you don't want to, maybe you shouldn't. Maybe you should buy Microsoft. Why should I pick on Microsoft? Maybe you should buy Microsoft, but can you withstand buying Microsoft? Can you make a value judgment? But the real analog, the real thing to talk about this morning is, if things change, how will you feel? Are the assets you buy, the strategies that you're engaging in, robust enough so that in a different environment you can stand it, or you can cut and run with minimal losses, or at the very least you should understand how you will feel. For the market to be down 20%, whether it's from down 7,000 or 10,000, whatever number, someday the market will be down 20%. For the market to be down 20% will require you to open up your newspaper in the morning and want to throw up. That's the essence of it. Every person around this table, not the smart people, not the dumb people, not the medium people, sophisticated, unsophisticated, every single person around the table. I think that's the thing to think about now when the financial asset environment is good. And therefore, when you're looking, it's not just an academic point, when you're looking at strategies and picking strategies and managers, I think you have to assess this important factor. What is the variability of this strategy? And will you change your mind with asset prices, with that manager down 20%? Will you say, that strategy doesn't work, that person no longer works? I'd like to briefly mention a couple of other factors, a human factor, incentives. The average hedge fund works on a percentage of the gains. There's nothing wrong with that. It's the way most people do it. And the incentive there is to build positions and to maximize profits. Many of the people doing it also have a very good discipline, but you should understand what the incentives are. The incentives of people on trading desks of the major brokerage firms who are trading is to trade big positions, because if you trade $20 billion and you make $200 million for the firm, you can get a $20 million bonus. It's the firm's money, it's not your money. You lose, you move down the street to the next firm. It's an important factor when assessing why your position size is so big, why is there so much trading. I think while there are other risks you should consider when you're thinking about risk, counterparty risk, sovereign risk, liquidity, I think this notion of leverage and also human factors are two factors that I think people ought to really think about in their decision making at the present time.
Well, thank you very much. Andrew and Koshik, Paul made the statement that we should be reticent about drawing too finely tuned quantitative measures of how asset classes move together. Maybe in your presentation I want to also comment on how you use quantitative techniques in risk management.
Thank you, and thank you, Paul. As you can probably tell, I'm English. I came over from the UK about 8 months ago. I'm in fact a Greenwich resident. I live on Taconic Road. I have my family here, my wife and 2 children. I seem a pretty mild-mannered sort of chap. But in Paul's understanding, I think I'm a dangerous heretic. I manage an offshore, highly leveraged, market-neutral fund. I employ derivatives. I have pretty much an unfettered choice of strategies and trades I can put on. And I suppose I'm about as far in left field as Paul was prepared to sit next to. In fact, You might notice there's an empty chair between us. We stare risk in the face every day. We take large positions, we focus on leverage, we focus on risk, and we put on trades which we think in the main are sensible uses of our fund's money. Now, to give you a little bit of background about myself, just in case I've just started doing this and this is something new to me, I've been trading these sorts of strategies now for about 10 years. I first started trading relative value market neutral strategies for a company based not far from here, Louis Dreyfus Trading. I ran part of their bond basis trading operation for a few years. Then I moved to Cargill, another commodity house, where I stayed in Minneapolis for a while, which was pretty cold. And most recently I've worked at Bankers Trust, where I managed a number of relative value arbitrage funds for them. So I've done this for a while. I've managed to avoid blowing up any of my investors, but throughout that period I have been running highly leveraged, complex positions, really just relying on our risk management overlay to protect ourselves and our investors. So what I want to talk about a little bit is leverage and about risk management, and to be a little bit contentious to explain why, in my opinion, leverage really is not a measure of risk, and why when you approach funds and funds managers, although it's worthwhile asking them about leverage, it doesn't really answer the question you're probably asking, which is, how risky is this fund? Now, I did a presentation yesterday morning in Midtown. There was a market neutral strategy conference, and I was talking about leverage. And it was mainly an institutional investor base, and unfortunately it was just before lunch. So half the guys had already left. There was mainly indifference in the audience. I think most of the people thought I was mad. But from our perspective, leverage really is not an issue. When we look at trades, we look at the relationships between securities. We're looking for small differences in large numbers, essentially. We focus on those small differences and then lever those small differences to generate the returns of the fund. Now, as Paul has said, there is risk associated with this. When you're trading the difference between two large numbers, as we are, if your analysis is incorrect, if your understanding of that relationship turns out to be wrong, you have the potential for a large loss. Now, it's our premise, and the returns of our fund seem to justify that, that by understanding a small relationship extremely well and levering that relationship, there is less risk than focusing on some broad market strategy and, as Paul would say, market timing, which people get wrong. So we look for very small relationships that we can understand fully. We understand all of the inputs that go into that relationship. We understand how that relationship will move in various market changes. We hedge those risks out, and then we level that position up to the point where it generates the sort of returns that our fund requires. Now, in some of our positions, this can be very low leverage. We have some trades where we have leverages of approximately 1. Merger arb trading, risk arb trading, in the main is very difficult to lever. Most people run risk arb books with leverages of 1 or 2. Some of the volatility trades that we implement for the fund can have leverages, depending on how you measure them, of somewhere between 20 and 50. We have a warrant trade on in Germany at the moment in Dresdner Bank with a calculated leverage of approximately 84. But that's not to say it's an extremely dangerous position, nor is it to say it's a very risky portfolio decision on our part. We manage the risk by understanding the relationship and leveraging the relationship to the level we're comfortable. Now, what I want to talk about a little bit is how we do that. I have a couple of sheets with me, which I'm certainly welcome to take on the way out. But it tries to compare the difference of P&L outcome. And what do I mean by that? It's kind of an oblique statement. What I've done is I've plotted the P&Ls you would have generated by investing $1 million in iOmega. So what I did is I said, let's assume we bought $1 million worth of iOmega, and let's have a look at our daily P&L. And the graph shows you what the daily P&L would have been for the last year. Now, if you look at that daily P&L and you work out some sort of measure of how variable is the standard deviation of that sequence, it's about $68,000. So on average, you would have anticipated $68,000 move on iOmega if you had this $1 million position. Totally unlevered. If I wanted to have a levered position in the 10-year note to give me the same level of P&L variability, I would have to have levered the position 15 times. So here we have two investments. I admit it's a bit of a example, but we have a totally unlevered position in iOmega and a 15 times levered position in the 10-year note. And from my way of looking at those positions, how variable is the P&L? They're both equally risky. Now, I could have come up with a more extreme example. I could have looked at Telmex ADRs just before the peso devaluation, and I could have looked at levered T-bills
And we did that example, but it was ludicrous. You ended up with a leverage ratio of about 500 to 1. You could lever T-bills 500 times and still have a less risky position than investing in Telmex ADRs. So what does that say? What it is saying to me is that just looking at the leverage does not tell you how risky a position is. You have to understand what the position is, what the risk management around the position is, and the volatility of outcomes. So, in answer to Paul's question, we had a little discussion before we sat down. Leverage is a good measure of risk if you have two identical positions. If you have position A unlevered, position A levered, the levered position A is certainly going to be more risky. But in the main, that's not how funds operate. When you invest in a levered fund, the risk control they're using and the trading approach is usually very different from an unlevered vehicle. At that point, I think it's unreasonable to compare an unlevered fund with a levered fund and say, just by definition, that levered fund is more risky. In our case, our fund, as I said, uses leverage. The leverage of our fund, on average, is probably somewhere between 5 and 10, if you amalgamate it across all the positions we have. The volatility of our outcome, however, is no more volatile than the S&P. So, are we riskier than the S&P? Probably not. But we're using about 15 times leverage. We're looking at relative value strategies. We're looking at arbitrage trades. So, the thing I would like to just leave with you as a thought, when you look at funds, when you examine the leverage that those funds have, think more about the strategies and the risk management that those funds are employing. Don't think quite so much about this leverage question. In fact, when you ask the leverage question, realize what you're really asking is how risky is this fund? Focus on the risk of a fund, focus on the risk of a position, don't focus on the leverage. It doesn't really tell you everything you need to know. One final point I would make is, and picking up on one of Paul's comments, market timing. I think most people would agree that the markets have had a pretty good run over the last couple of years. Being a hedge fund manager with a fund which is quite a risk-controlled fund with reasonably low return because of that, people always ask me, why should I invest in your fund when the S&P is giving you 30% year on year? It's a very good question. I think one of the things which levered funds and arbitrage strategies allow you to do is diversify away from the stock market returns. I think it's very difficult to find alternative assets to diversify away from. And I think if you do want to diversify away from the stock market or the bond market, you will find yourself having to invest in arbitrage type funds, market neutral type funds, and you will be having to get invested in trades and with managers who use leverage. So I think it's worth focusing on this question. I think it's worth thinking about the risks associated with leverage, particularly if you find yourself in a situation of diversifying. So I'd leave it there.